Hi everyone, before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2023 October-November Paper 2 1 question number 4. This is the Paper 2 which consists of 4 questions. 2 of them will be of 30 marks and 2 of them will be of 15 marks. And the total time limit given for this paper is 1 hour and 45 minutes. Since question number 4 is of 30 marks, ideally you should be spending about 35 minutes in order to solve this question. And in this video as well, we'll be attempting to solve this question under 35 minutes. So without any further delay, let's get started. Javed manufactures a single product. He currently uses a system of absorption costing but is considering changing to marginal costing. The following budget information is available for 1 unit of the product. We have the selling price per unit, direct material per unit, as well as the direct labor per unit. Then we have our budgeted production, which is 12,000 units per month. And we have the budgeted fixed overheads, which is of 36,000 per month. Then at 1st August, Javed held no inventory. Okay, so for the opening inventory of August, that will be 0 because he has no inventory. Then the following actual results are available. We are given the actual results for the month of August and September. We are given the sales units, the production units, as well as fixed overheads. Now we need to prepare a profit statement for each of the months, August and September, using absorption costing. Remember that we are talking about absorption costing, and using absorption costing, we can also calculate the overhead absorption rate. And the difference between absorption costing and marginal costing is that while calculating our closing inventory under absorption costing, we value it at our direct costs as well as the fixed overheads because we calculate our overhead absorption rate. So in this case as well, we need to include the direct cost, which is given right here, direct material as well as the direct labor, but we also need to include the fixed overheads. So let's calculate the overhead per unit. And this should always be calculated based on the budgeted information. So total budgeted fixed overheads is given to be 36,000 per month. And the total production units is given to be 12,000 per month. So we're just going to divide it by 12,000, which gives the overhead per unit to be 3. So we need to include this along with our direct cost. So let's figure out the total cost per unit. That is just going to be 7 for direct material, plus 5 for direct labor, plus 3 for the overhead, which gives a value of 15. Okay, let's start with our profit statement. So this is similar to our statement of profit or loss. So we start with our revenue. And the calculation of revenue is pretty simple. We just need to multiply the sales units given by the selling price per unit. So for the month of August, that is just going to be 8,000 times 18, which results in 144,000. Then for the month of September, that's going to be 12,000 times 18, which results in 216,000. Now again, the step will be similar to our statement of profit or loss. We can now move towards our cost of sales, which means that we can start with our opening inventory. And for the month of August, we are told that there will be no opening inventory. So that's just going to be 0 in this case. We'll calculate this section for September separately. Let's first go over all of the items to be included. Now, after opening inventory, we usually include the purchases. But in this case, we are producing our own goods, right? So rather than purchases, a more appropriate heading would be our production cost. Let's write it down. And this should include the cost of production of the total units produced. And in this case, we've already calculated the total cost per unit. That's 15. So in order to calculate the production cost for the month of August, we just need to multiply 15 to 10,000. So that's just going to be 10,000 times 15, which is 150,000. Then the final item will be the closing inventory. Okay, remember that closing inventory are just those units that have been produced in the current month, but we are yet to sell it, right? And in this case, we produced 10,000 units, but we are only able to sold 8,000 units. So out of 10,000 units, we sold the 8,000, which means that the remaining value or the remaining units is just going to be our closing inventory. That will be 10,000 minus 8,000, which results in 2,000. And remember that in case of absorption costing, closing inventory will be valued at the total cost itself. So in order to calculate its value, we just need to multiply the 2,000 to 15. That gives us the value of 30,000. And again, since the process is similar, we need to subtract the closing inventory as well. Let's calculate the total of our cost of sales for the month of August. That's going to be 0 plus 150,000 minus 30,000, which results in 120,000. And this also we need to subtract from our revenue in order to get our profit, or the gross profit in this case. And remember, this is not the final profit, because we are operating under absorption costing, which means that we also need to adjust for any under absorption or over absorption. Okay, so the gross profit will be 144,000 minus 120,000, which is also 24,000. Now we repeat the same process for the month of September. Okay, we start with our opening inventory, and remember, the closing inventory of last month is just going to be the opening inventory of next month. And in this case, the closing inventory for the month of August was 2,000 units, which means that this will now act as the opening inventory for the month of September. Again, opening inventory is valued at the total cost as well, since we're operating under absorption costing. So that is going to be 2,000 times 15, which again results in 30,000. So that will be the opening inventory for the month of September. Now for the production cost, we just need to multiply the production units for September, which is again given to be 10,000, by the total cost of 15. So that's 10,000 times 15, which results in 150,000. Now we again need to figure out our closing inventory for the month of September. Okay, so for our month of September, we produced 10,000 units, but we also have the closing inventory of 2,000, which now acts as the opening inventory in the month of September. So the total units of goods that we have for the month of September is going to be 12,000. And out of 12,000, we can see that we sold all of the 12,000 units. So there's no remaining inventory in this case, which means that there will be no closing inventory for the month of September. So that will just be 0. Now we can calculate the total of cost of sales for the month of September. That will be 30,000 plus 150,000 minus 0, which is also 180,000. And we again need to subtract this value in order to get the gross profit. So that will be 216,000 minus 180,000, which results in 36,000. Okay, now we need to look for any under absorption or over absorption in this case. For our over or under absorption, we already have the actual fixed overheads. And in order to calculate the over or under absorption, we just need to compare the actual fixed overheads to the budgeted fixed overheads. Let's calculate the budgeted fixed overheads. And remember, the comparison basis should be the same. And the basis is going to be the actual units produced, which in this case is 10,000 for both the months. And remember, we are not to use the actual units sold, because we're talking about the overhead per unit, which will be incurred at the time of production, not at the time of sales. That is why we need to consider the actual production units. Okay, so we just need to multiply the actual production units to our budgeted overhead per unit. That is just going to be 10,000 times 3 for both of these months, which gives the value of 30,000. Okay, now we need to compare our budgeted fixed overheads to the actual fixed overheads. And in both of these months, we can see that the budgeted overhead is greater than the actual overhead, right? This results in a case of under absorption. And the under absorption value is just going to be the difference, which in this case is 6,000 for both the months. And always remember, in case of under absorption, we need to subtract that value from the gross profit. In case of over absorption, we need to add that value to the gross profit. Since this is a case of under absorption, we need to subtract 6,000 from both the months gross profit. Okay, and we can just write it under the heading of under absorption. Then we finally get the total profit. For the month of August, that will be 24,000 minus 6,000, which results in 18,000. And for the month of September, that will be 36,000 minus 6,000, which results in 30,000. This completes the first part. Let's move towards the next one. We now need to prepare a profit statement, the same thing as above, for each of the months of August and September. But in this case, we will be using marginal costing. And remember that profit for marginal costing is fairly simple as compared to absorption costing, because we only need to include the direct cost while valuing closing inventory, which means that the total cost utilized in order to calculate our production cost or the closing inventory is not going to be 15 in this case, since we only include the direct cost. That will be 7 plus 5, which results in 12. This is the cost per unit for our marginal costing. And we first need to calculate the contribution by subtracting the total direct cost from our total selling price. Then we subtract the given actual fixed overheads from the contribution in order to get the profit. Let's start with the revenue. So revenue is not going to change since we are applying the selling price of 18 to the total units sold. So we can just copy down the amounts of 144,000 and 216,000 for our revenue. So that's 144,000 for August and 216,000 for September. This is for the revenue. Now we again need to follow a similar process. We need to include our opening inventory, then our production cost, and our closing inventory. And we've already calculated the units of closing inventory and the units of opening inventory, right? And the units of production is given in this case. So we don't have to do that. We just need to calculate its value by multiplying it to the cost per unit for marginal costing, which is 12. So for the opening inventory for the month of August, it was given to be 0, which means that it will be 0 in this case as well. Then the total units produced was 10,000. So the cost of production of 10,000 units, and we're only including the direct cost, is just going to be 10,000 times 12, which is also 120,000. Let's write it down. So opening inventory will be 0. We have 120,000 as our production cost. Then the closing inventory units for the month of August was calculated to be 2,000. Again, the closing inventory will be valued at the direct cost. So that will be 2,000 times 12, which is also 24,000. And we need to subtract the closing inventory. Okay, so the total cost of sales for the month of August will be 120,000 minus 24,000, which is also 96,000, which we again need to subtract in order to get the contribution in this case. Now we repeat the same process for, let's calculate the contribution as well. That will be 144,000 minus 96,000, which is also 48,000. Now we repeat the same process for the month of September. Now, the closing inventory of the month of August will act as the opening inventory for the month of September. So that will be 2,000. Again, it will be valued at the direct cost. That's again 2,000 times 12, which is also 24,000. Then for our production cost, that will again be 10,000 units. So that's 10,000 times 12, which is also 120,000. And we've already calculated that the closing inventory for the month of September was 0. So opening inventory's value is 24,000. Production cost was 120,000. There's no closing inventory. Now the total of cost of sales for September, cost of sales or the direct cost, will be 24,000 plus 120,000, which is also 144,000, which we need to subtract in order to get the contribution. So that will be 216,000 minus 144,000, which is also 72,000. Now the last step would be to subtract our fixed overheads. And remember to include the actual fixed overheads. That's already given in the question to be 36,000 for both months. Now we can finally calculate the profit. Okay, so the profit for the month of August will be 48,000 minus 36,000, which is also 12,000. Then we repeat the same process for September. That will be 72,000 minus 36,000, which is also 36,000. That's all for the second part. Let's move towards the third one. We now need to prepare a statement reconciling the absorption cost profit for August with the marginal cost profit for August. Okay, remember that the only difference between absorption cost and marginal cost is that marginal cost only includes the direct cost, but absorption cost includes the direct cost as well as the overheads. And this difference is clearly seen while valuing the closing inventory in case of the month of August, right? Okay, let's prepare the statement. We have to reconcile the absorption cost profit. So we start with the absorption cost profit, which was 18,000. And we need to reconcile it, right? So the reconciliation will have to be made to our closing inventory, because in case of absorption costing, the closing inventory was valued at the direct cost as well as the overhead, but in case of marginal costing, it was only valued at direct cost. So the only difference here will be we need to subtract the overhead factor from our closing inventory valuation. And remember that the overhead per unit was 3. Closing inventory unit for the month of August was 2,000. So the total value that we need to subtract is just going to be 2,000 times 3, which is also 6,000. So we need to subtract 6,000 from our absorption cost profit. Now this eliminates the overhead from our closing inventory. And we're only considering closing inventory because remember that within the production cost, previously in case of absorption costing, we had included the overhead as well. And in case of our marginal costing, that overhead is included as part of fixed overheads right here. So that has already been adjusted. The only adjustment to be made will be for closing inventory. Now we get our marginal cost profit. That will be 18,000 minus 6,000, which is also 12,000. which is correct because we calculated the profit to be 12,000 under marginal costing for the month of August. That concludes the third part. Let's move towards the fourth one. We now need to advise Javed whether or not he should change from absorption costing to marginal costing. We need to justify our answer. So in this case, we just need to compare our advantages and disadvantages for absorption costing to that of marginal costing. The very first thing that we can write down will be the decision-making process. Remember that absorption costing can be used for long-term decision-making, whereas marginal costing can be used for short-term decision-making. Let's write it down. So absorption costing is useful for long-term decision making, whereas marginal costing is useful for short-term decision making. Okay, and this is of 7 marks. Okay, we have compared 1 point for absorption costing, 1 point for marginal costing. That's 2 points. We still need 6 more points. We need a total of 6 points. So we've already written down 2 points. So we need additional 4 points and then one final decision. And another thing for absorption costing is that it is very useful for setting our selling prices because the total cost incorporates our overhead as well. The total cost per unit incorporates the overhead as well, but that is not true for marginal costing. And for marginal costing, we always split our costs into fixed and variable cost, but not all costs can be split into fixed and variable cost, right? So that's a disadvantage for marginal costing. Let's write it down. We can start with absorption costing. Can be useful in setting selling prices. Then under marginal costing, not all costs can be split into fixed and variable costs. Okay, that's 4 points. We still need 2 more. For our absorption costing, the basis of apportionment may be arbitrary, right? Because we choose the basis of apportionment, and that might not reflect the true apportionment factor or true apportionment basis. So the basis of apportionment under absorption costing may be arbitrary and for marginal costing we do not have to calculate an overhead absorption rate, so that will act as an advantage. Let's write it down. No need to calculate overhead absorption rate under marginal costing. Okay, now we need to make a decision. And remember that marginal costing is more suitable for businesses that make a single product. And in this case, at the beginning of the question, we were told that Javed manufactures a single product. So due to this factor, I'm going to advise Javed that he should change from absorption costing to marginal costing as it is more suitable for businesses that is producing a single product. So decision would be that Javed should change from absorption costing to marginal costing as marginal costing is more suitable for businesses that make a single product. Alright, that's all for the fourth part. Let's move towards the fifth one. We now need to state two possible causes of overabsorption of overheads. So always remember that overabsorption of overheads occurs when our actual overhead is less than the budgeted overhead, or the actual production is greater than the budgeted production. So these are the two things that you need to list down. The first one is that the actual overheads are less than budgeted overheads. And the second cause is actual production is more than budgeted production. That's all for the fifth part. Let's move towards the sixth one. We now need to explain one difference between a cost center and a cost unit. So we can just define what is meant by cost center and cost unit in this case. Always remember that cost center is a particular product, or it can be a service as well, or it can be any location where the costs are actually allocated. So that's the location where the cost arises. Whereas a cost unit is a unit of output to which the cost can be charged, so that we can calculate the cost per unit. Let's write it down. So cost center is a product or service or location where costs are allocated, whereas a cost unit is a unit of output to which costs can be charged. That's the sixth part. Let's move towards the seventh one. We now need to state how closing inventory is valued using each of the inventory valuation. The first one is FIFO method. That's first in and first out, which assumes that whenever we use goods in case of production or while selling, the order in which they are sold is the order in which they are received from the supplier. So the first good that we receive from the supplier will be the first one to be sold. The last good that we receive from the supplier will be the last one to be sold, or last one to be used within production in case of raw materials. Let's write it down. It assumes that goods are used in production or sold in the order in which they are received from the supplier. We then have the AVCO method, which is the weighted average cost. And under this method, we need to recalculate the cost of inventory after each purchase. So we can just write that down in this method. The average cost of inventory is recalculated after each purchase. Alright, that's all for the seventh part. We can now move towards the eighth one. Javed is investing the just-in-time method of inventory management. So as the name suggests, just-in-time method of inventory management refers to the method where we only purchase the raw materials at the time of its requirement. So we do not store any sort of inventory beforehand for any future use. We only buy the necessary supplies whenever the order for such goods comes into the business. We now need to explain a principle of the just-in-time method of inventory management. So the basic principle is that our supply of raw materials will only be purchased exactly when they are needed in production process, and we do not store it beforehand. Let's write it down. Supplies of goods or raw materials are received or purchased exactly when they are needed in production process. And No inventory needs to be stored beforehand. Alright, that's all for the 8th part of this question as well as this entire question. If you found this video useful, make sure you like the video and leave a comment below, and make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.